Good morning. My name is Mike Zlatnik. I'm a fund manager for Tempo Opportunity Fund, Tempo Growth Fund, and I'm a CEO of TF Management Group. This presentation is based on a book that I have published, and it's all about the top questions you need to ask before investing in any fund or a syndication. I hope this is an exciting topic for you. It certainly is for me. And it is updated for the summer of 2020. Appreciate your time in advance. A disclaimer, this is for educational purposes only. We are not offering to sell anything at all, nor are we providing any kind of advice. If you are interested, please consult with a professional CPA or an attorney. And we're in a private lending and fund management business. If you're interested in one of our funds, please request a private placement memorandum. That is the only offering document, and it's available to accredited investors only. And please consult with a professional for any questions. Just a couple of words about me. I live in Brooklyn, New York. Married, 4 kids and a cat. Cat is the 5th child. Those of you who have pets can appreciate that. We have a family of funds under TF Management Group, income fund, growth and income fund, and a growth fund. I had a past career in software as a software executive. I retired full-time from it 2009 and went real estate full-time. Been a real estate investor since 2000, and this is my passion. I love real estate. This is the best thing out there since the sliced bread. And we have a couple of areas of specialty. We do bridge lending, hard money lending, as well as number of value-add investments for forced appreciation and predictable cash flow in broad range of sectors, multifamily, self-storage, and so on and so forth. Do have a book out on Amazon, How to Choose a Smart Real Estate Investment Fund, Top 10 Questions One Should Ask Before Investing in a Fund. And I do have a podcast called Big Mike Fund Podcast, where I interview some of the top movers and shakers around the country who do real estate, investment gurus, and so on and so forth. So if you're bored, you got nothing else to do, Big Mike Fund Podcast may be a place for you to learn a couple of things. Again, bigmikefund.com is a place to find me. We do have a number of other sites, but that's the easiest way to find me, bigmikefund.com. And if you misspell it and you go to bigmikefund.com, it is not a kinky site, I promise that. So appreciate your time. Let me keep moving forward. So top 10 questions we're going to cover right now. And the reason these questions are important is because you're considering a substantial investment from your qualified or non-qualified account, and you're looking for the key answers to your questions. So let's start with this really important stuff. So this is a short list, but we'll dive into each of these questions as we go through slides. So what is the security of my investment? What is the return on investment? How is the fund income taxed? What is the liquidity of my investment? What kind of fees the fund manager earns? How frequently there are payments? What is the manager's experience? Type and quality of the deal flow? Fund investment strategy, is this an open-ended or closed-ended fund? There are some advanced questions we'll cover as well. So one of the questions to ask yourself, and the reason I'm saying top 2 questions to ask yourself is because you got to have goals. If you don't have goals, you will be investing in a bunch of shiny objects. This is critically important. So I start this presentation with the questions you should be asking yourself, not a fund manager, just for your own best education, for your own understanding of where you're going. If you don't know where you're going, how do you know you got there? That's all about the plan and the goals. So know your risk tolerance. If you're not comfortable with high degree of risk, don't invest in risky things. You want to make sure you sleep well at night. What is your cash flow objectives? What is your total return objectives? What kind of tax efficiency you're looking for or none? If you're investing with IRA account, you couldn't care less. If you're investing with non-qualified money, you may want to enjoy depreciation. So important questions. How well do you want to diversify? what's your time horizon, what's your liquidity requirements. All those things are very, very important for you to build portfolio goals. And then what is my asset allocation strategy or your asset allocation strategy? So allocation capital between investment quadrants, and I will talk about investment quadrants in a second, gives you a little perspective. It's like a planning, but a planning with the good understanding what is the risk level of each investment and what's the reward. Is there cash flow, is there growth? So let's dive into that. So investing versus speculating, very important consideration. The reason this matters is most people don't know the difference. They just see a shiny object, they see an offering in front of them, and they just invest because there's a top line figure says, hey, you're gonna earn 18%, you're gonna earn 20%, you're gonna earn 25%. But what kind of risk are you taking? Is this a speculative investment or investment grade that is fairly safe? These are really, really important consideration. Again, Benjamin Graham, the godfather of value investing, Warren Buffett learned from Benjamin Graham. Define investment as an operation is one which on thorough analysis promises safety of principle. These are the key words, and a satisfactory return. Anything else is speculative. So know the difference. Pay attention when you have an opportunity. Think of this: is this an investment grade or a speculative grade? Here come the quadrants, my favorite topic. I've put them together. I will have a new book out soon that'll cover some of this. The quadrants is very simple methodology. I didn't invent the wheel. The quadrants have been around, but the quadrants, the way I'm presenting them, a little bit different from some other quadrants. So just think about this. When you're investing in something that is investment grade, and the key definition of investment grade is, does it have a good downside protection? Mechanisms of downside protection differ. We'll show you some examples. So if you're investing in a first lien mortgage secured by a deed of trust, a first lien note secured by a mortgage or deed of trust, it's fairly safe investment, and when it's performing, it's generating cash flow, and it's got healthy loan to value ratio. That's a safe investment. That is a quadrant one like investment. So first lien mortgages at conservative LTV have good downside protection, fall in these quadrants. Some good syndications, multifamily with good cash flow that generate, that have conservative first lien mortgage at low LTV, lots of equity, good coverage on the debt, also falls in the quadrant one. Quadrant two examples would be deals that don't have a cash flow, they're growth investment quadrants, but they still have investment grade characteristics. So here's what's an example. Well, a defaulted mortgage that you buy a non-performing note, and it is at a low LTV or ITV, investment to value ratio. So you bought a note for $100,000, the collateral was easily worth $200,000. It's fairly safe. You will be able to foreclose most likely and collect on your principal and all the due interest. You're just missing on the cash flow, but you have great growth opportunity through accumulation of default interest and late fees. So that's a quadrant two deal, just as an example. Quadrant three deals your second lien mortgages. They generate cash flow. Again, quadrant one and three are cash flow quadrants, and quadrant two and four are growth quadrants. But second lien paper is speculative in nature. If the first is defaulted, your second is at risk of complete loss of capital. That's why it's a speculative investment. Quadrant four deals are all your development, redevelopment, land speculation. The deals that don't have a cash flow, they have high degree of risk, and you can lose all your money because they're so speculative. If construction fails, or it takes too long, or their cost overruns, all of those things create potential risk. So it's really important to consider. And here in blue, I gave some investment targets. These things change. This is what we see when we invest. In your world, you may see better opportunity or worse opportunity. It all depends on your deal flow. Who do you know? What kind of opportunities? And these things change with market conditions. So the next very important project before we decide to invest into anything, including funds and syndications, is the fact that all deals have risks. And here's a list of risks. So whenever you invest and whenever you get a pro forma projected return or fund return proposed of 18% or 15%, always adjust for risk. Understand what is in a fund or a syndication and adjust for the risk associated with that type of investment. Investment grade projects have lower degree of risk. Speculative grade projects have high degree of risk. And the general formula, very basic math, your risk-adjusted return is one of the most important terms that people use. If you talk to hedge fund managers, Wall Street fund managers, very, very sharp cats, they talk about risk-adjusted return, not promised return, not projected return. So the general formula risk-adjusted return equals to the projected return minus loss reserves. And loss reserves vary depending on the type of speculation a given project. Please understand that most offering documents, most of the offering memorandum, private placement memorandum, use, realistically speaking, their best case scenario, pro forma. Why? Because they use it as a marketing tool. So you have to assume whatever you're promised is a pro forma that is designed for really good, ideal conditions. In most markets, you need to adjust for risk and reduce the expectation. So your own expectation should be reduced no matter what's proposed. Otherwise, you'll be disappointed, because 90% of times, any kind of projects, on average, don't meet their pro forma. They lag behind. Some of them lag a little bit. Some of them lag a lot. Also depends on the market. If you're on a booming market, many sponsors are successful because the tide rises all boats, and they catch a good wave. They do well because of that. That has been the case for the last 10 plus years, because from the Great Recession until now, not counting the COVID impact. But even during the COVID, we're still doing relatively well, based relative to the past 10 years. So the point is, yes, the risks have increased right now. I would very much caution that during the COVID, a lot of uncertainty, a lot of risk, although we're getting a lot of capital infusions from the government and some of those risks being mitigated. But long story short, always think about risk-adjusted return. Here are the same quadrants. Now we have risk-adjusted ROI. And that's something for you to think about. Generally speaking, quadrant 1 and 2 risk adjustment is only a couple of percentage points on average. In different market, the number could be lower or higher. Quadrant 3 and 4, which are speculative quadrants, have a much higher risk adjustment. Typically 6 to 8% could be higher, depending on the type of deal or market conditions. So question number 1. How secure is the investment? The most important question. Well, you need to understand what you're investing into. You got to ask the fund manager, what's in the fund? Is the fund leveraged? To what degree? Big leverage, big risk. Some funds, I'll give you an example. I've talked to a number of fund managers, and some are equity funds, and then they raise 25, 30% of the capital, and then they invest in deals with 70% leverage. That's 70%. I'm not saying it's bad or good. It's just there's a bigger leverage. The bigger the leverage, the bigger the risk. Now it depends on what assets they invest in. If they were investing, for example, in hospitality or retail, pre-COVID, leveraged, and the COVID hits, and the industry is devastated, you could lose all your money. This is a critical consideration, why it's so important to diversify, and two, to know what you're investing in and what kind of leverage it has. So leverage is one of the most important considerations. The lower the leverage, the lower the risk. Now you can magnify your returns with good leverage, but understand, again, that you can get hurt due to leverage. Are you investing in a fund that is investing in a bunch of first lien mortgages or notes at safe LTV, or are you investing in a fund that invests in a bunch of defaulted notes or large commercial notes at a good LTV? These are just examples. And the numbers change. So pre-COVID, 70 to 75% was okay. Ideally below 70%. Now, I would say it's even lower post-COVID. And then non-performing notes used to be good at 65% or lower LTV or ITV. Today, it's down to below 60%, in some cases below 50%. Very, very important. Are you investing in leveraged investments? And what is the leverage? Is the leverage 2 to 1, 65, 66% LTV, or is this greater? There's an important commercial term called DSCR, debt service coverage ratio. How strong is that? In other words, how much cash flow they have to service the debt. If a cash flow falls, this ratio is a safety margin. The higher it is, the better it is. And are you investing in income generating or value add asset, or combination of the both? So these questions are critically important for you to understand the safety of the investment. Don't look at the top line, look at what's in the fund. If a top line projection is adjusted for risk and corresponds to what's in the fund, that may be a good sign that you can invest with confidence. And again, safety first. In today's environment, in the COVID environment, it's very important to be thinking about what is the safety first. If you can establish that, it may be a level of comfort for you to invest. Again, tastes differ, different strokes for different folks. You may be comfortable with the risk, but today, I, as a fund manager, always think, what is the safety first? Question number 2, what's the projected annualized ROI? So let's start with basics. The ROI, or return on investment, comes in of 2 forms. One is the cash flow, and 2 is appreciation. So your total projected return is a top line number, and it needs to be broken. How much cash flow is going to come to investors and how much will come in the back end as appreciation. Lots of projects out there have light cash flow and significant back end appreciation. That appreciation is speculation. It is based on a projection of a future value, and it is plausible, it's very possible, but it is unknown. So the deals with more cash up front are generally better. Again, not everything is equal, and there are different deals. Some deals with great cash flow could be terrible, and some deals with great appreciation could be great. But in general, on average, the deals that give you cash flow, at least to me, feels a little bit better. Again, depending on the strategy, we do have great growth strategies. But if you are considering same level of return on a deal that gives you, say, 12%, 6 comes in cash, 6 comes in appreciation, versus a deal that gives you nothing in cash and all on the back end. Of course, you take the one that gives you some cash as you go. So again, what's the net return to investors? Not on the fund level or a project level, but to investors. The other question you can ask, if the fund has a history, what's a trailing? I think I have it misspelled here. What is the trailing 12 months if the fund has been doing distributions? If no distributions, obviously not applicable. And what are the last quarter returns? Please understand, some funds operate on quarterly basis and distribute quarterly, and some funds are not. So it's very important to know the difference. Some projects, again, during COVID, have suspended distributions, but there's nothing fundamentally wrong with them. And some projects have suspended distributions because they have problems with collections. Knowing the differences is very important, especially in today's day and age. Again, a critical metric that I like to use is what percent of the total return comes in the form of cash flow. So if you are projecting to get 6 out of 12 in the form of cash flow, that's 50% of return comes in cash. If you are getting 75%, that would be 9% if your target was 12. So these are very important characteristics, because cash is the king. If you're getting cash today, it's better than promised money in the future. Just a consideration. You can gravitate to a growth investment, but you need to be getting a higher rate of return on a growth investment versus a similar investment that generates cash flow. In other words, if you have an income opportunity and you are making 12%, a similar growth opportunity may need to make 15% because you're foregoing the cash to generate greater return in the future. And then I like projects that have value add or forced appreciation, not natural appreciation, but forced. In other words, the sponsor work improves the value, and as a consequence, the cash flow improves, and then the value of the asset improves. So value add strategy understanding is very important too, and it drives, obviously, total return. Understand that the sale price or refinance value may not meet projections. Again, back to the point that a lot of these projects, just give you an example, one of the key metrics they use is a cap rate. And the cap rates historically have been contracting recently, at least in the last 10 years, there's been significant contraction, more than 10 years. The reason for this is that the interest rates have been falling. And we are living in an environment of very, very low interest rates, and so are low cap rates. There is a risk of interest rates going up. I don't think it's a huge risk because the United States is likely moving towards same model as EU or Japan are facing. The reason for this is debt. As debt continues to grow, countries can't afford to pay high interest rates on its own debt. So they push the rates down through Fed policy or central bank policy. And the rates are where they are now. They could go negative. There's a reason why the rates go negative. Well, people ask, how can the rates be negative? Well, they can. The reason the rates are negative is negative rates are better than default. That's the simple driver of negative rates around the world. It's another discussion subject, happy to chat about. Let's keep rolling forward. But the point I'm making here is supply, demand of the money, interest rates, the cap rates may not be where the sponsor projects. Good sponsors do what is known as sensitivity study, and they look at what returns to investors would look like if the cap rates were higher or they were lower. And similarly, depending on their value add strategy, they look at NOI. If net operating income is also part of sensitivity study, it's like a table. The higher the NOI, the better the exit price. The lower the cap rates, the better the exit price. So a combination of those two factors generally drive the exit price, and the exit price drives some of these projections or likely returns to investors. So these are very, very important facts. Here's, again, you see correlation between the interest rates and the cap rates, and the trend has continued. This was through 2017, and the last couple of years, the trend continued. We're now very low interest rates and even lower cap rates. Economic slowdown can obviously affect this type of trend. Fund income and taxation, very, very important. So if you're investing qualified money, you may not care. But what you do care about, if you invest non-qualified money and you're getting great depreciation, you can actually use it. Depreciation benefits could be significant tax savings if the two main case scenarios. Again, if you're investing non-qualified money, number one, you could sell appreciated assets, kind of have capital gains, and you can offset them with passive losses. So it's called PALs versus PIGs. PIGs, passive investment gains, need some PALs, passive allocation losses, which come when you have an investment with depreciation benefits. Or if you're a real estate professional, you invest and you can take passive losses from generated by depreciating projects, and you can offset against your current income. On a non-qualified investment, if you're an IRA investor, you don't really care. It doesn't make a difference. Depreciation neither hurts you nor adds any value to it. What does, something that you have to think about, is when you invest in a syndication with your IRA, and a syndication has leverage, just multifamily syndication, and you're investing in that deal with IRA money, leverage comes in the form of a mortgage. Most multifamily deals are bought with mortgage. That leverage of having a mortgage, say the mortgage is 75% of the purchase price and 25% is investor capital. That capital has leverage, and the income generated from that project for your IRA may trigger a UBIT. So consult your CPA, but in a very simple case scenario, if it's traditional IRA, not a 401k. 401ks generally don't really care. It's a self-directed 401k. They're okay with leverage, while IRAs or Roth IRAs would be subject to UBIT. Again, consult with your CPA before making an investment decision. I'm just giving you general educational guidelines here. Again, so what part of the income generated from a fund or syndication is subject to taxation? So if a given investment, it could generate passive investment income from real estate, could generate interest income, and these are different type of investments. Interest income is perfectly happy for IRAs. Ideal income for IRA investors is interest income or capital gains, while for a non-IRA money, interest income is actually taxed at a higher rate. So it's kind of really important to know what's inside of the thing you invest in, what kind of income it's going to generate for you, and make sure it is a good match for the source of money. Again, depreciation benefits. Some projects have accelerated depreciation. We have a project, give you an example, just very quickly, where for 100,000 invested, you can get in the first year 250,000 of accelerated depreciation due to a segregation study and a high leverage. Is this a good thing? It depends for who. If you're a non-IRA investor and you have some capital gains, you want to offset it, that's perfect. If you're an IRA investor, you couldn't care. So it really depends. And then obviously, capital gains are enjoyed by both non-IRA investors and IRA investors because they are taxed in the most advantageous manner. And for IRAs, they're perfectly suitable. And what's really interesting is the distributions may not be equal to the income reported for tax purposes. In real estate, it's a very, very common. And that's the reason to invest in real estate, is that it does have tax benefits. Again, consider the risk of leverage investment from your IRA into leverage syndication, because it can trigger UBIT or UDFI. That's the tax. Liquidity of the investment, very important. So some investments are liquid and some investments are not liquid at all. So if you invest in a value add, new construction of a self-storage facility, it's going to have no liquidity until there is a refinance or sale event. Nothing wrong with self-storage. Love the asset class. Same could be true for anything. New construction, ground up, or multifamily might not have any cash flow for a few years. Same for various asset classes. So again, the questions you should ask: what's the liquidity? Is there a redemption mechanism? So some funds have redemption mechanisms. Open-ended funds generally do. Some don't. Closed-ended funds and syndications may not have redemption mechanism. So that's a very important question to ask. And how much capital of the fund sits in a cash and short-term investments providing liquidity mechanism, and what portion of the fund investments are long-term. Again, those things can help you determine whether it's liquidity or not. So you should ask a question: is there a lock-in period if it's an open-ended fund? How long it is, and how often people can redeem. Some funds redeem on a quarterly basis, some redeem on an annual basis, some redeem on a monthly basis. Really varies. Again, most syndications and closed-ended funds do not have a redemption mechanism. They need to find another investor to step into your shoes with permission of a syndicator or a fund manager. You may be able to substitute. But in general, there's no liquidity mechanism. I'm not saying anything wrong, but if you're investing for 5-year horizon and the fund has no liquidity for 5 years, great, it's a good match. But if you need liquidity in 2 years and something has a 5-year projected life cycle, it's a mismatch. The next question: what are the fund fees and are they fair? So there are a lot of stuff circulating on the internet. So many sponsors, self-claimed gurus offering deals, promoters, they are pushing all kinds of deals, and a lot of it is crap. I mean this in a nice manner. Forgive me, I hope I can say that. Not using a bad term, I usually don't use bad terms, but you have to know the sponsor. You have to really know, like, and trust them. You have to understand the investment. It has to make sense. And then if you are comfortable with those things, then you can make the investment. Don't be fooled by these shiny objects with high promised returns. It's all game of numbers to attract you to something that has 25% return. Now, I'm not saying all projects are wrong. There are legitimate, great value add projects with strong returns, but you have to know the difference. If you don't know the difference, you can't invest because you don't know what's good and what's bad. Anyway, here's some examples. So very important to understand that there's alignment of interest. How does manager make fees? You want to make sure they are aligned with you. What I like is when the managers get paid when the fund or syndication performs. What I don't like personally, when a manager collects a lot of asset acquisition fees, development fees, and a bunch of other things upfront or as you go, but not when there are critical milestones achieved, and they get paid ahead of you. That's something to worry about, something that can make them rich and then hurt your return. So something important. So management fees, there's no right or wrong number. Typically, they're in the 1.5–2% range. I've seen funds with 3% management fee. There's nothing wrong with any number. Obviously, it has to make sense for both the manager and you. So 1.5–2% range is typical. There are bigger funds with 1% because they have economy of scale. There's nothing fundamentally wrong with the number, but you need to look at all those things in combination, not just in a single variable. Performance fees matter. So most funds have waterfalls, and they may have a preferred return, like 7%, and then they have a performance split above 7, 60-40, 70-30, 80-20. Those things are important. Also, you should look at what kind of asset origination fees or acquisition fees a sponsor or fund manager charges. Again, somebody charges 1% asset acquisition fee, maybe 2%, that may be within reason. While I've seen sponsors that charge 6% asset acquisition fee, those are high. I mean, they're getting paid up front, 6% of the money you put in the deal up front, or not even your money, but based on an acquisition price. They had a mortgage leverage, they may be collecting massive amount of money relative to the capital raised. So those things are important to pay attention to, and they need to be disclosed. They need to read and understand. So I'm gravitating to deals where there's alignment of interest, where you get paid ahead of the sponsor. And some pay in. Please understand, sponsors and fund managers like myself, we need to make a living. So there's got to be some realistic and reasonable fees, and sometimes upfront, sometimes as you go, but most of it is back-ended. Then it's a fair deal. Again, how much will the manager make relative to the investors? So here's an example. Say investors get 12% and the fund manager makes, between the fund management fees and performance fees, 4% total per year on average. That's a fair shake. They get 70, you get 75%, they get 25% of a total return. That's a fair deal. Is that the right ratio? There's no, guidance, but 70-30, 75-25. The bigger the fund, the bigger the deal, the higher investor percentage. So on a big deal could be 80-20. I mean, there's nothing right or wrong. What I don't like is when the reverse. We'll be very careful. If you see a deal, hey, we'll pay you 10% pref, and then you guys get 10% of the upside. What about 90%? We put up all the money. We're taking all the risk. If it's 90-10 in the investor favor, that's great. But if it's 10-90, well, there's something wrong with that. So it depends. There's nothing right or wrong. Things vary. But this is an example for you to consider how the fund manager is compensated. So fair split of the pie is between 60-40 in favor of investors to 80-20. In that range, on most funds I've seen, non-institutional level, not massive funds, it's a typical breakdown between all fees, asset level fees, acquisition fees, so on and so forth. And is manager motivated to get you higher returns? What I like is low or no asset acquisition fees or origination fees to the manager, and more on the back end. So just consider this as guidance. It varies, but at least gives you framework how to look at manager fees. So here's examples of some good waterfalls, good funds. So you could have a high target. Again, what's important is what is net to investors. It's not just the total return on the fund level, but net of all fees. What are investors projected to make? And then let's look at the preferred return. So good preferred return today's environment is in the 7-8% range. Sometimes they're higher. I've seen one-off syndications where you could get 12% pref. There's nothing right or wrong. But in that, with funds, 7-8% is fairly decent pref. The key word here is cumulative. You will hear cumulative non-compounded. Well, non-compounded just means if it's underpaid, there is no interest on interest. There's no compounding, but it needs to be caught up. That's the word cumulative. So if this year there's pref of 8% and they only distributed 4, the next year they need to catch up to 4. So next year it's 8 plus 4. If it's underpaid for a number of years, it still needs to be caught up when there is a refinance or sale of an asset. So on a growth type of a fund, cumulative pref is critical. Imagine there are no distributions for 5 years. The 8% grows and accumulates to 40% preferred return due to investors ahead of any kind of performance fee. So very, very important. Also depends obviously on closed-ended, open-ended fund, but cumulative pref, in my opinion, is an absolute must. Whenever you see non-cumulative pref or the sponsor can't answer the question that it's cumulative, it's a no-go. Fund management fees, again, reasonable 2%, and then waterfall after that. So if investors invest more money, it is normal and typical. Like in this example, they would get a higher pref. This is a common practice. I've seen it again and again on syndications and funds, and it is a healthy practice. Again, I like the numbers 80-20, 70-30 in favor of investors. Those are good numbers. Can a manager make some kind of asset acquisition fee? Sure, 1%, that's fair. I mean, even higher, 1.5, 2 could be within reason. You go away when you see 5%, 6%. Those numbers are scary because the manager gets paid up front to do the deals. Small fee is legit for the work that the manager does. And then distributions could be quarterly or not. Back to the distributions. So again, some funds that have cash flow would distribute. Some funds that don't have current income can distribute on capital events when there is liquidity to distribute. Just a key differentiation. Another good example. Income and growth fund, again, target to investors, and then cumulative pref, and then another waterfall you could see. You could have 3 tiers of units, 60-40, 70-30, 80-20. All of this is perfectly common and acceptable. If it's an income fund and invest in a hard money loan, one of the very important questions to ask is, where do points and fees go at the origination? There's some funds that keep all the points and fees. Some funds give all the points and fees to the fund, not the manager. They're a very broad range. Obviously, as a fund investor, you love to hear that all points and fees go to the fund, while you don't want to hear that all points and fees go to the manager and the fund gets nothing. A common setup is a compromise. You'll hear 50-50. So if a manager charges if the manager originates a deal and they charge 3 points, half of them, 1.5 goes to the fund, half goes to the manager. That's a fair shake, more or less. There's no right or wrong, but it's a balancing act. And in some funds, manager doesn't charge any asset origination fee. So much the better. I do believe that manager needs to be motivated. So some level of asset acquisition fee is applicable and appropriate. And we have both in our funds. Some of our funds don't charge any asset acquisition fees. Some charge small ones like 1%. It's a fair shake. Again, be wary of the situations where a syndicated charge heavy asset acquisition fee. That's a way for them to get wealthy and for you not to know or shave off your return. Again, here's a syndication. Good target, again, projected IRR, good range. Generally, there's no right or wrong. I like the numbers to be in the mid to high teens when I value add projects. Light value adds, the heavy value add should be higher. It really depends. Depends on the type of project, risk-adjusted return. Cumulative pref, management fee, 1% is great. As I said, 1 to 2% range is fine. Split 70-30, perfectly acceptable. And then asset origination to the manager, 1% is perfectly legit, and what kind of cash flows the deal gets. So you should ask this type of question. This is an example of pretty good cash flows, and most of the return comes in the form of cash flow, which is great. Here's some examples of bad deals. Something that you really have to pay attention. So you see total return to investors sort of capped at 12%, and the preferred return is lower and then non-cumulative. The moment I see non-cumulative, it hurts my eyes and ears, but I've seen those. Management fees, sometimes unclear. Sometimes there's a complex formula and you can't understand that, which is ridiculous. Performance split, I've seen some crazy deals out there, and many great marketers, again, with all due respect, I know many of them, they're phenomenal people, but because they're such good marketers, they feel that they can get a big part of the shake or big part of the return while investors get less. In my opinion, it's a little bit too one-sided. So I've seen 50-50 over 6% deal, but the moment investors get 12%, they cut off it all, which is not right. They're taking all the risk with money. They need to have, I don't want to call it a limited upside, but significant upside. Here's a deal where the manager gets more than investors. It's a 6 pref and a 30/70 in favor of the manager, which is not right. Distributions, well, depending on the deal, right? If the deal has no cash flow, it's a value add deal, there are no distributions. So you really have to pay attention. I'm not saying there's anything wrong with no distributions in the early years. Just pay attention. If a deal has strong cash flows and there's somehow there are no distributions, where's the cash going? It's a question to ask. Origination fees, here's example, 4%. I've seen higher, I've seen 6%. I've seen deals were charged 12%. They use broker dealers, and it's written in the PPM where there is 10-12% upfront gets shaved off of every dollar investor puts in because they're paying all kinds of fees for broker dealers, which is, again, not saying it's right or wrong, but it, as an investor, you just have to be aware. And I personally would never invest in a fund like that, but it's your consideration. So cash flows, some deals have strong cash flows, but they'll only distribute a pref. Every dollar over the pref stays with the manager. So I've seen deals which basically say, hey, it's 6% pref to investors, and then every dollar above that until manager gets 6% goes to the manager. It's basically 50-50 from day one. They just get investors for 6%. So these type of deals are not ideal, and I consider them bad deals. Another word of caution: when it's too good to be true, it maybe is. There are fraudsters out there. There are fraud syndications, there are fraud funds, there are Ponzi schemes. So you have to be aware they exist. I absolutely worry when people start paying predictable 10% no matter what happens. Doesn't matter what happens with the deal, but they pay you 10% day in and day out. That's what Bernie Madoff did. He paid 12% no matter what happened. And you know the whole story. There was no really returns behind it. He just raised new money and paid all the investors and kept rolling this forward for many, many, many years. There are deals like this today where people are getting distributions even though there's no supporting income behind it. And I very much worry about these type of deals. So be aware. Sponsor fraud, lack of integrity. Some sponsors don't use third-party administrators. They run in-house accounting, and they hide problems or take some money off the table without you knowing as an investor. That's why very important to use third-party administrators. At least there's a much lower chance of funny business from that perspective. Again, lack of integrity or deal mismanagement. Again, I'm not saying it's all fraud. There are situations where good deals just go bad. And mismanaged construction, mismanaged lease up, mismanaged tenants, creating high risk conditions, getting slip and fall accidents, getting lawsuits, all those things could create problems. So sponsor mismanagement could cause all kinds of issues. Could be contractor errors, could be market conditions. Again, COVID. Again, don't have to go far. What did it do with hospitality assets? I don't want to call them destroyed them, but severely damaged them. Many retail projects have been hurt very significantly too. Again, they looked good before COVID. Once COVID hit, there's been substantial impact, and it's a market condition for a specific asset classes. Some other asset classes are doing just great. Self-storage, multifamily, we love those asset classes. They are lightly impacted, if not impacted at all. While, as I mentioned, hospitality is in barely survival mode. It can die. Many deals will go upside down. Same with retail. A lot of assets will just collapse. They'll go upside down, file for bankruptcy, go through restructuring. If you invest in these projects, you may lose all your money. New unexpected competition, I've seen that pattern. Sometimes you can invest in a self-storage facility with great feasibility study. It looks great when you start, but somebody else also thought it was a good location, and they opened competition right across the street. It does happen. So you could have great, well underwritten projects, market conditions change, competition pops up, things can go bad. And then projections could be far away from the reality. And this is something that you have to be very mindful, and that's why you have to adjust for risk. And remember, there are no guarantees. The more you hear the words, it's guaranteed. Well, who guarantees this? You guarantee it, your management company? That's not a guarantee. There are only two guarantees in life: death and taxes. And then that's, for all intensive purposes, the guaranteed investments are something you could have U.S. Treasuries. They're secured by the full faith and credit of the United States, but everything else is not guaranteed. So, although there are insurance products and some bonds are insured and so on and so forth, but even insurance company can go bust. So just be aware. Question number 6, frequency of distributions. Let me keep rolling forward. I think we are kind of a little bit short on time, so I'll keep pushing forward. You could have quarterly distributions, you can have monthly distributions, or you could have distributions upon capital events, refinancing, sale. It really depends. If it's an open-ended fund focused on income, you can have quarterly or monthly. If it's a growth fund, you may have no distributions initially until there are projects that get to an exit point or some cash flow starts. So just that's a question to ask. Can you reinvest distributions? It's a good question. If you get your cash, if it's an IRA account, it doesn't need distributions, there might be a reinvest distributions option. What's been the history of distributions? Looking at the last quarter, looking at the last 12 months, look at the distribution since the inception of the fund. Same is true for syndication. If it's an ongoing income syndication, what has been the history of distributions? Rarely ever you can get into the syndication midway. But if you have that opportunity, you can take out another investor. Looking at the history of distributions helpful. This is more applicable to funds than syndications. Again, what's the total return? How much of it comes in the form of cash flow? How much of it comes in the form of distributions? Sorry, cash flow and distributions, and then how much of it comes on the back end in the form of appreciation, capital gains when the asset is sold. What's the management team experience? Very important. There are specialists. We invest in many of them who all they do is self-storage projects, value add, self-storage, and there are specialists who do value add multifamily, and there are specialists who do retail. Again, retail is a beaten up sector, but at the same time, there are specialists and they may find great deals, and you may consider participating. Sometimes it's a redevelopment. You can invest with specialists who do hotel conversions to affordable housing. Very legitimate, great repositioning value add strategy. If the sponsor is a specialist, they've done projects like that, great. So these are the important consideration. Again, the industry, the current fund or current syndication, and with the past funds, and the track record. Last 12 months, last 3 to 5 years, and if they have longer, great. Type and quality of the deal flow. So the question you can ask the fund manager or a sponsor: where do you get your deals? Where do you source them? Do you market for these deals? What kind of relationships do you have? What is your network? How do you source these deals? And at least getting a good answer can help you understand what is their business like. You're investing with them, and you want to understand that they have a methodology to get sort of off market or some of the market deals. Just they have an ability to get quality deals. They have good relationships, and they're able to acquire better than average, better than market deals with a good value add strategy. Now, you go back to this very basic concept, what Warren Buffett said. I would rather pay a fair price for a great company than a great price for a fair company. The same applies to real estate. So you could find a great asset at a fair price, not necessarily a great price, but the value add strategy and the location might be phenomenal, and then maybe a better deal than looking for, rougher area, worse type of location, but a great price. There are reasons why Warren Buffett believes in that. In real estate, location, and it's very important to pick good locations rather than look for greatest asset, cheapest deal, because you get what you pay for at times. You get a really good deal, well, you think it's a good deal, and then you go through the value add strategy in an area is severely depressed and you thought you can get higher rents, but you can't. So these type of considerations are important. Again, what type of deals a sponsor gets? So very important to understand, are you investing in debt? Is it performing debt? First in mortgages? Is it second lien mortgages? Is it mixed of both? Is it non-performing assets? I've seen non-performing seconds as crazy as you can. There's some funds that do that. I know great fund managers. It's their specialty, but something you need to understand. And that creates, higher degree of risk or lower degree of risk. Again, performing debt, non-performing debt, equity, the type of asset type, location, the size, what kind of value add strategy. It varies by, value add on a multifamily might be renovations of apartments internally, uh, kitchens, appliances, flooring, bathrooms, paint, and external roofs, siding, common areas, clubhouse. All those things can improve the value of an asset. Where you go on a value add, conversion of an old hotel to affordable housing, that's a value add. Conversion of an old Macy's to a self-storage, that's a value add, different. And how good are these deals? What's the risk reward ratio? What's the target ROI? What's the downside protection? All these questions are important questions about the deal flow. What is the fund strategy? How diversified they are. The question is applicable to funds, not syndications. With the syndications, I mean, I've seen syndications covering more than one asset. At times, you can acquire more than one property. So there's a little bit of diversification. With funds, very, very important to look at how many assets they got, the typical asset size, the biggest, what is their distribution, what is their various dimensions of diversification in terms of who the fund invests into with other sponsors, with borrowers to make loans, where they're located, what deal types, investment size. So diversification strategy is what mitigates risks. One of the two main benefits investing in a fund, if you think about it, one of them is diversification, probably one of the most important, and two, better access points. So fund managers, because they pull the money together, they can put more money to work than you as a single investor, and they can negotiate better deals, get into better units or classes, or better terms, get side letters. So it's part of the fund strategy. So diversification is very important. Obviously, access point into better deals. Asset types we talked about. There are focused funds in multifamily or self-storage or retail, and there are diversified funds. Our funds are diversified, so we spread the risk among many asset classes. So it's very important, and I have great friends who have very focused strategy. I have a great friend who we invest with who does distressed commercial debt in New York. I have another friend who does self-storage income projects, and another that has value add self-storage fund, and so on and so forth. So these type of strategy are important because you need to know how diversified you are. If you're building a portfolio, you have a portfolio plan, and a fund is part of the plan, how does it fit? If it's diversified, it's better than focused. Although people will say, well, in a focused one, I could make more money if that's successful. True, absolutely true. But you've got to build portfolio with building blocks, and diversified blocks are better initially, and then you can take some well understood risks with the specific targeted syndications or focused funds to take advantage of a given industry or a sector. So there is a lot to this, but understanding fund strategy is critical. What is the niche? Some folks specialize in hard money, many hard money funds on fix and flip projects. There's some hard money on new development, self-storage development or development, tax deeds with tax certificates, mobile parks, non-performing nodes, so on and so forth. The sky's the limit. Understand what is the niche of the syndicator or fund managers. Ideally, what you would love to hear that they have subject matter expertise. They're not necessarily jack of all trades, but it depends. Diversified funds, they have to be jacks of all trades. Focused funds, they have to have an area of focus. And then are you investing in equity or debt of the fund? And if you're investing in equity, is their leverage. Like we talked about, leverage works both ways. Leverage creates risk. It can magnify returns, but it also creates risk. Some more on the fund strategy. Is the fund focused on growth, income, or growth and income? Your objectives could be growth and income. You want to find a matching fund. If your objective is growth, you don't need the money for a few years, great, find a growth fund, and so on. If you're near retirement or at retirement, you may want to look for an income fund. And then risk profile, what kind of assets they invest in, riskier assets, higher leverage, lack of diversification, all those things create risk. And then lower risk due to lower risk profile, no leverage, more conservative investments, good downside protection. All those things are important. Question number 10 is an open-ended, closed-ended. So the big difference in open-ended, closed-ended funds is that open-ended funds typically raise money periodically, every quarter, every month. They have a period, so sort of the subscription redemption period where you can go in and out. The closed-ended funds don't do that. They raise the money during open capital raising period, and they close. There's no more money going in and no money going out. Because they invest in the projects and then they stay in these projects through the life cycle of these projects until these projects sell. That's the basic difference. So many open-ended funds are known as an evergreen because they keep rolling forward, raising money, redeeming, and keep going forward. While the closed-ended funds just invest, they can raise money for 12 months or 24 months and they close, and then they can run for 5 years, for example. In the projects that have a value add strategy, and upon completion, restabilization, increase of the income, increase of the value, they sell and they exit. Some distinctions between open-ended and closed-ended. One of the big challenges with open-ended funds is if they raise money periodic basis, say quarterly, they have to value their portfolio on quarterly basis, meaning that they have to value all the assets and compute price per unit or price per share. And it has a degree of complexity, and some of it is subjective. We run both an open-ended, a couple of open-ended funds and some closed-ended funds. There's nothing wrong or right with each one. It's just different. So open-ended funds generally have better liquidity, while closed-ended funds may not have liquidity, but they have other benefits. So another interesting consideration, open-ended funds could have a yield drag related to the growth projects in the income portfolio, while the closed-ended funds don't really care. They could have a tax efficiency and not worry about yield drag concepts. So just some of these considerations. Again, period of time that the fund raises is really important. Liquidity is important. Distribution times are important. And then exit strategy. Some funds have an exit strategy. First, the refi, return of capital, and then they have an exit event where the asset is sold and a full repayment takes place. So all those things are important. Again, closed-ended funds have dynamics, as you can see here. When on open-ended funds, we talked about quarterly or monthly subscription, and then mark-to-market concern, which is both a beauty and a curse, depending on how you look at this. And they continue to acquire and dispose assets from time to time, distribute current income or capital gains, and then the investments are there sort of indefinitely. There's no particular exit point, exit time. The closed-ended funds have a finite timeline, and they need to exit all assets sooner or later. Some of the advanced questions. What is the fund transparency or syndication transparency? I absolutely think it's critical. So one of the questions to ask is, are you using third-party fund administrator, and who they are? Why it's important? Again, not saying Bernie Madoffs are frequent, but they do happen. And if an operator says, well, you have in-house accounting, all that stuff, I mean, no argument. But it is somewhat of a risk. If a third-party administrator does their books, the risk of cooking the books, in the manner of speaking, is much lower. So also, do they communicate what's in the fund? How often do they communicate? So communication strategy, frequency, updates, Help investors to build confidence. Again, quarterly performance and updates, investor calls, ad hoc updates has been obviously a big deal during COVID. And what's interesting is if fund managers have one-off projects, one of the questions to ask, hey, if I write you a check to invest in your fund, when you have one-off deals, will you give me a co-investment opportunity? And that could be a significant benefit where you could take advantage of the fact that the fund manager negotiates better terms for the fund, and you can come in being invested in the fund in the same type of deals as a co-investor instead of having to pay somebody a promote on your money. So important consideration, or at least valuable consideration. Some more advanced questions: deal selections. So what percentage of the deals that a fund manager syndicator reviews and underwrites go to funding? And the number generally should be fairly low. There's no right or wrong, depending on market conditions, depending where the deals come from. So I'll give you an example. We only look at deals on referral, no cold deals at all. It could be the best deal out there. If it doesn't come from a known source or an existing investor or a referral, we won't even look at it. So for us, it's less than 25% because we only look at quality deals. We don't even start with anything else. And some people look at, I know multifamily guys who will look at market listed deals, ton of them, they analyze a lot of them, and their percentage is a whole lot lower than 25%. There's no right or wrong. It's more of it depends on the individual situation, but it has to be a low number. If people invest into every deal that comes across, they don't have they don't have good processes. Let me put it this way. So so what percentage of actual deals that people look at get funded? And in general, it's low number, right? I mean, below 10% could be lower, a lot lower, and it's important. So the important considerations are this: you don't want to spend a lot of time wasting, looking through deals, but at the same time, to find a gem among other stones, you have to look through a lot of them and know what a gem looks like. So these are some key considerations. If a fund manager is very competent and they know what they're looking for, when they see a deal, they know it's a deal. But they got to look at a lot of the no deals or bad deals before they can pick a good deal. So something to keep in mind. And what's the general selection underwriting criteria? You can ask what kind of deals you're looking for. What are how do you know it's a good deal? Maybe that's the right question to put it. So should you invest in individual deal or funds? So this is a very useful table. I hope you understand and appreciate what it is. This gives you some difference between individual deals and funds. And I'm not saying there's anything wrong with individual deals, but you just got to understand, and I'm not saying anything wrong, but you can make better returns on individual deals when they go right, and you can get hurt when they don't go right. With funds, one of the key benefits is diversification. You should have lower volatility based on diversification, while if you look at individual deal, you have risk concentration, higher volatility. Individual deals may have lower liquidity. You may be stuck in the deal until it exits. In a fund, if they have a liquidity mechanism, you may be able to get out earlier. Some individual deals, when you invest in, you may have to co-sign. I mean, if you invest with partners, there might be a PG. Now, it's not typical in syndication. LPs don't sign a personal guarantee, but when you invest in an individual deal with partners, that may be the case. I'm just using the individual deal as an example. It doesn't have to be syndication. It could be you buying an asset with partners, or it could be a syndication. Syndication, no PG. If you invest with partners, likely you'll have to sign a personal guarantee if you go to a bank, if it's a recourse loan. Generally, invest in a fund, there are no personal guarantees. I've never seen a fund requiring LP investors or passive investors to sign any kind of personal guarantee. Potential liability risks. Again, if you're a partner and you own a building and you're involved, there is some risks of liability. With funds, it's a limited liability risk. In general, you invest through an LLC, and by definition, you're shielded from the liability of the entity itself. Individual deals may require active participation. Specifically, If it's a partnership or you bought the property, you have to be active. You have to drive the value add strategy. On the other side, if you are a passive investor in syndication or fund, you don't need to worry about that. Generally, funds, you're very passive. Um, Sometimes your money comes back in the form of distributions, and depending on type of investment, some funds accept distributions and some of them don't. So in a fund, generally speaking, that accepts reinvestment and distributions, your money is always working in the deals that send the money back to you, they repay. You could make a hard money loan or hard money loan fund. Hard money loan fund, the money is always working. For example, in a hard money deal, you wrote a check, the deal repaid. Now you're sitting on idle funds. Just an example. IRA investors, when you invest in a single deal with leverage, the chances are that it's you bit risk. Again, if you invest with partners, if you invest in a leverage syndication, you may be subject to UBIT. And then with IRA investors in a fund, if the fund itself has no leverage on a fund level, there should be no UBIT. And then the amount of money that you invest, kind of something to consider about. When you invest in a fund, it could be very flexible. Some funds allow reinvestments, open-ended funds, so it could be flexible. Closed-ended funds, you can invest some money now and some money later, as long as it's before the end of the closing period. With one-off deals, you got to have the right amount of money for the deal at a time of a deal. So you pretty much you go with that amount, and that's your only option. Again, these are not necessarily negative, just differences. That's my favorite slide in the presentation. I think it's the last slide. It's the Brooklyn Cyclone, the oldest wooden roller coaster, and some people love riding on it. I don't. It squeaks, it has its ups and downs, and to me, it's not as much fun. To some people, it is. So I prefer smooth sailing, picture on the right. The primary purpose of diversification is smooth sailing. COVID absolutely redline the problems with certain sectors. And if you weren't diversify, you're experiencing roller coaster ride. If you invest into a diversified fund, you may be experiencing a little bit of a small wave up and down, but in general, it's a whole lot more smooth sailing than a non-diversified investment. Appreciate your time and consideration. I'm at your service. Thank you kindly, and thank you again. You can find me at bigmikefund.com. I'm at your service, and that's the name of the podcast. You could link to the podcast through the same website. Thank you kindly.